All right, buckle up, news junkies. The pace of change is absolutely relentless, and here at Electro Drive News, we're your pit crew, keeping you ahead of the pack. We've got a tidal wave of updates hitting us from all corners of innovation and industry, and you absolutely do not want to miss a second of it. Get ready for a rapid-fire rundown that's going to redefine what you thought was possible. From the streets to the stock market, and beyond, the future is unfolding right now, and we've got the inside scoop. Stick around, because this is the information you need to navigate the ever-shifting landscape. First up, a groundbreaking development in autonomous transportation that's finally opening its doors to the public, but with a few intriguing conditions that might just surprise you. You won't believe who's expanding and what it takes to get on board. Next, we're diving deep into the economic currents that are sending shockwaves through the markets. Are we seeing cracks in the foundation of the job market? And what does this mean for major financial players? Plus, we'll look at how one company's stock is making major moves amidst these shifts, signaling a potential pivot in financial strategy. Then, we're shifting gears to look at global market performance, where one electric vehicle giant is absolutely crushing it in key international territories, driving up sales and defying expectations. But is this global success enough to weather the storm of economic uncertainties and investor caution? We've got the numbers and the analysis. And finally, we're getting a direct update from the top on a revolutionary transportation service, with big promises about when the human element will be completely removed. Get ready for the future of mobility, as it's being revealed right now. Don't touch that dial or that refresh button, because you're about to get the essential download. Subscribe now and hit that notification bell so you never miss a beat. The future of rides is here, with a catch. Get ready, because the world of autonomous transportation is officially rolling out the red carpet for the public. Tesla has just announced a major expansion of its Robotaxi service, moving beyond exclusive test groups to open its doors for everyone to join the waitlist. An app is now available, signaling a significant step towards a future where hailing a driverless car could become as common as ordering a pizza. However, this grand unveiling comes with a few fascinating caveats, making the journey to full public access a bit more nuanced than a simple download. The rollout is described as expanding access soon. And crucially, the app is currently only available on the US Apple App Store, with an Android version slated for the future. This phased approach hints at the complexities of scaling such a revolutionary service. For those in Austin, Texas, where the service has been undergoing testing with limited access for influencers and investors, the expansion means potentially wider availability. During the test period, rides were confined to a specific geofenced area and did not include the airport. Tesla has shared glimpses of the service in action, including a reported 10-minute ride in Palo Alto, California, for a startlingly low fare of $4.20, with no tipping expected. While this initial pricing is subject to change, it offers a tantalizing preview of potential cost savings for riders. The service is also set to include San Francisco in its expanding network, further broadening its reach. The operational details are still evolving, particularly concerning safety. While the test fleet in Austin has been seen operating on highways with a safety monitor in the driver's seat ready to take over, the specifics for public riders remain somewhat unclear. City driving tests have involved safety drivers in the passenger seat, but it's uncertain if this will continue for paying customers. Adding another layer of complexity is a new Texas law that went into effect September 1, requiring a safety driver unless vehicles are certified as Level 4 or Level 5 autonomous. Tesla's current full self-driving system is classified as Level 2, meaning they haven't yet met the higher autonomy standards required to operate without human oversight in all conditions under this new legislation. This regulatory hurdle is a significant factor as Tesla navigates its public rollout. It's also important to note that Tesla is not the sole pioneer in this space. Competitors like Alphabet's Waymo are already operating fully driverless services in multiple cities, including San Francisco, Los Angeles, and Austin, often utilizing more advanced sensor technology like LiDAR alongside cameras. Tesla's vision-only approach, while innovative, faces intense scrutiny and legal challenges regarding its self-driving claims. Recent comparisons have shown that while Tesla's Robotaxi shows promise, it is yet to surpass the established capabilities of leaders like Waymo. This expansion also arrives as Tesla CEO Elon Musk increasingly emphasizes robotaxis and humanoid robots as central to the company's future, potentially overshadowing the importance of its traditional electric vehicle business. Musk has long promised widespread autonomous Tesla fleets, projecting millions of vehicles globally within a short timeframe. The announcement follows Tesla's decision to halt development of its Dojo supercomputer, a move that shifted reliance to external chip and cloud service providers for its AI and data processing needs. This strategic shift has led some investors to view Tesla as moving from a leading innovator to merely another automaker offering advanced driver assistance systems, especially as competition intensifies from both established automakers and emerging players. But what does this mean for the broader economic picture? Stay tuned as we explore the surprising signals coming from the job market and what they could mean for future financial policy. Economic tremors. Is the job market about to break? Traders and economists are on the edge of their seats, with all eyes fixed on the upcoming jobs report, as mounting evidence suggests the U.S. labor market might finally be showing signs of significant strain. The latest figures on initial jobless claims have surged to their highest point since June, a clear indicator that the employment landscape is becoming less robust. Adding to this picture, ADP's private payrolls report delivered a surprisingly meager gain of just 54,000 jobs, falling far short of expectations. Furthermore, hiring plans reported by Challenger, Gray, and Christmas for August reached their weakest levels on record for that month. The collective message from these indicators is that employers are becoming more cautious, pulling back on expansion and potentially signaling a shift in hiring strategies. This mounting evidence of labor market cooling is fueling a dramatic shift in market expectations regarding Federal Reserve policy. Bond traders have reacted swiftly, driving down yields across the yield curve. Futures markets are now pricing in a near certainty of a rate cut by the Federal Reserve at its September meeting, with projections suggesting at least 2 more rate cuts could follow in 2025. The equity markets are already anticipating this potential shift, with rate-sensitive stocks, including Tesla, experiencing upward momentum on the prospect of cheaper capital becoming available. If Friday's official jobs report confirms a 4th consecutive month of job gains below 100,000, a streak not seen since 2020, it could provide the Federal Reserve with the justification it needs to pivot from its current policy of holding rates steady to actively cutting them. The prevailing market narrative is rapidly moving away from concerns about inflation and is increasingly focusing on economic fragility. Analysts are closely watching for confirmation of this trend, as it could signal a significant change in the economic cycle. The potential for a Fed pivot represents a major development that could influence investment strategies across various sectors. However, this path is not without its risks. Will Compernol of FHN Financial warns that continued softness in the labor market could easily push firms from merely freezing hiring into initiating widespread layoffs, which would further exacerbate economic concerns. Jamie Cox at Harris Financial Group suggests that Federal Reserve Chair Jerome Powell may soon find himself with little choice but to implement easing measures to support the economy. Meanwhile, Chris Larkin at E-Trade cautions that while slowing job growth might be viewed positively in the short term as a catalyst for lower interest rates, a sustained and deepening trend could quickly reignite fears of a potential recession. The significance of this upcoming jobs report cannot be overstated. It's not merely a statistical release, but a potential trigger for a fundamental shift in monetary policy. The implications for investors, businesses, and consumers are substantial, making this a pivotal moment in the current economic cycle. As the economic winds shift, we turn our attention to how global markets are reacting. Get ready for an update on a major player's international performance and what it means for their standing. Tesla's global surge, record sales amidst market crosswinds. Tesla continues to make waves in the electric vehicle industry, demonstrating remarkable resilience and growth in key international markets. Recent sales figures reveal a significant surge in both China and Turkey, underscoring the company's enduring brand appeal and its ability to capture market share even as it navigates global economic complexities. In China, Tesla's sales performance in August was nothing short of spectacular, with a month-over-month increase of 22.5%, marking it as the company's best wholesale month of the year. This robust performance in its largest market highlights Tesla's continued dominance and its capacity to drive demand despite broader economic fluctuations. Simultaneously, Tesla has witnessed an explosive demand for its Model Y in Turkey. Sales in August saw an astonishing rise of 86% compared to the previous month, catapulting Tesla to become the second best-selling auto brand in the country. This achievement is a powerful testament to the growing acceptance and desirability of electric vehicles in emerging territories and indicates significant untapped potential in these regions. These bright spots in China and Turkey have helped to offset some of the challenges Tesla is facing elsewhere, particularly in Europe and India, where performance has been more subdued. Despite these impressive international sales figures, the unpredictability of Tesla's stock price serves as a stark reminder that strong delivery numbers alone are not always sufficient to insulate the company from external economic pressures. Factors such as persistent inflation, rising interest rates, and fluctuating global demand continue to pose challenges. The juxtaposition between Tesla's operational successes and its stock market performance raises a critical question for investors. Should one place faith in the narrative of worldwide growth and innovation, or heed the warnings about potential overvaluation and prevailing macroeconomic headwinds? Tesla appears to be an enterprise excelling in innovation and steadily gaining considerable market share across the globe. However, its stock performance remains a complex equation, demanding patience, conviction, and a significant tolerance for risk from those holding onto their investments. The company's ambitious vision, stretching as far as Mars, is mirrored in its relentless pursuit of technological advancement. Yet, the market's reaction suggests a cautious approach, weighing the tangible achievements against the broader economic uncertainties and the inherent volatility of the automotive and technology sectors. Investors are tasked with deciphering whether the company's innovative prowess and expanding market presence will ultimately outweigh the macroeconomic risks and competitive pressures it faces on a global scale. While international sales are soaring, attention is also turning back to the future of mobility right here at home. Get ready for a direct update from the CEO on when autonomous rides will be truly driverless. Elon Musk's bold timeline: safety drivers out by year's end. In a significant announcement that signals accelerating progress in autonomous driving technology, Tesla CEO Elon Musk has declared the company's intention to completely remove safety drivers from its Robotaxi fleet. This move represents a critical step towards the full realization of driverless transportation, a long-held vision for the company. Musk stated that the safety drivers, who have been present during initial testing phases, are primarily a temporary measure for ensuring extra safety during the early stages of operation. He projected a clear timeline, suggesting that there should be no safety driver by end of year. Currently, Tesla's Robotaxi platform utilizes employees in various capacities to ensure safety. In city rides within Austin, Texas, and during all rides in the Bay Area, a safety driver occupies the front passenger seat. For highway operations in Austin, a safety monitor is stationed in the driver's seat, equipped to take control if necessary. Musk's statement implies a phased removal of these human oversight roles, starting with the elimination of the passenger seat safety driver and progressing to removing the driver's seat monitor, especially for highway driving. This strategy aims to transition the vehicles to a fully autonomous state, shedding the crutches the company employs during its developmental stages. The presence of safety drivers or monitors has been a focal point for critics and skeptics of robotaxi technology. Concerns about the reliability and safety of fully autonomous systems are prevalent, and any incident involving a driverless vehicle could have significant repercussions for the entire industry. Tesla, however, maintains that its approach is driven by a paranoid attitude toward safety, recognizing that even a single negative incident could derail the progress made not only by Tesla, but also by its competitors, such as Waymo. By keeping human oversight in place during these crucial early months, Tesla aims to mitigate risks and gather extensive real-world data to refine its autonomous systems. Musk's ambitious goal of having Robotaxis operating for half of the U.S. population by the end of the year, coupled with the plan to remove safety drivers, sets a rapid pace for development and deployment. It remains to be seen whether Tesla can consistently meet these aggressive timelines, especially considering the regulatory landscape and the technical challenges inherent in achieving true Level 4 or Level 5 autonomy. The company's insistence on a vision-only system, without the LiDAR sensors used by many competitors, adds another layer of complexity to this pursuit. The success of this plan hinges on Tesla's ability to prove its system's safety and reliability to regulators, the public, and investors alike, all while operating under the scrutiny of a watchful industry and a public eager for, yet cautious about, the advent of fully autonomous vehicles. And that wraps up our top stories for today. But before you go, let's do a quick recap of everything we covered. And that's a wrap on another action-packed news cycle. We saw Tesla open its Robotaxi service to the public with some interesting conditions. The economic forecast is looking shaky with signs of a cooling job market, potentially triggering a Fed pivot. Tesla's international sales, especially in China and Turkey, are booming, showing strong global demand. Plus, Elon Musk is aiming to remove all safety drivers from Tesla's Robotaxis by the end of the year. Don't forget to like this video, subscribe to ElectroDrive News for all your essential updates, ring that notification bell, and let us know your thoughts in the comments below. You can also follow us on all our social channels to stay connected. See you next time.